All right. Hello, everyone. My name is Alyssa Frederick. I'm a corporate partner in Lowenstein's Palo Alto office. My practice focuses on emerging companies and venture and growth equity investors. And I am joined by several of my wonderful women partners here who I will hand this over to shortly. But so welcome to I think it's our fourth presentation for women in the venture community. When I see the numbers that show what a relatively small percentage of venture dollars are controlled by women decision makers and flow to female founders, I'm frankly surprised because that's not what my own practice reflects. And Lowenstein has, for a really long time, intentionally developed a wonderful network of women, both founders and operators and investors. So we've been really enjoying this series. I hope you have as well. And these sessions are intended to share what we're seeing in the market, which is this year a really different market than what we've been seeing over the past long time. And so we focused on some of in the previous sessions on deals. Today, our topic is equity compensation, which is, of course, really essential to founders, to executives, and to investors, especially investors who are sitting on corporate boards and making decisions about executive comp. So I'll turn it over to Megan Monson, who is a partner in our equity compensation group, and Taryn, our colleague in this.
Great. Thanks so much, Alyssa, and thanks everybody for joining us today. I just want to start off with a general disclaimer that you'll see that the slides we're using today are very detailed. They will be shared after the presentation, and they're detailed because they're intended to be a reference material, but by no means are we really intended to get into the weeds and all of these practical items that we're going to talk about today. Again, it's really going to be a high-level discussion focusing on things that we think are relevant, both, from get smart, becoming well-versed and being able to speak equity compensation, and also what we're seeing from a practical standpoint. So really, one of the reasons that we wanted to have this conversation today is focus on the importance, which Alyssa alluded to, of really why VC women, women founders, and women kind of involved in any sort of venture-backed companies should be well-versed in equity-related matters. And there's really kind of a number of reasons. I mean, one is if you're, an investor, and by virtue of your investment, you are now sitting on the board, you're going to be in those key rooms making key decisions about the compensation that, key players at your organization have, and they're really going to be driving the success of the entity that you're involved with. And so really being able to understand, one, what is market, and have, a say in those discussions is really important. And just really kind of getting a base level understanding for the terminology and, coming to the table armed to really be able to share your perspective and have some say in those rooms. I also want to add, this is intended, again, to be a high level but interactive discussion. And so if you have any questions throughout, feel free to put them into the chat feature and we'll address them throughout. We're also going to save some times for Q&A at the end. And it's really intended to not be the end of the conversation, but just the beginning. Next slide, please.
About that, I was muted. There are a few types of equity-based awards that are typically offered under an omnibus equity plan for C corporations. The one that we see the most frequently, stock options, and that includes incentive stock options and non-qualified stock options. We also frequently see restricted stock units, and stock appreciation rights in omnibus equity plans. Outside of the equity plan, we also see companies issue phantom equity awards as an alternative to equity-based awards. And for LLCs, profits interests are also an equity-based incentive that's utilized. Alyssa, would you like to talk a little bit about when each type of these awards are used in a company's life cycle?
Yeah, sure. So setting aside LLCs, which we don't usually, which venture funds typically don't invest in, at the outset, we have founders granted restricted stock. That is the one time in a company's life cycle when anyone can basically just get stock for free. So you can grant it at a price that is very cheap to buy, and also you have basically no tax at that point. So that's why founders get restricted stock. And then founders also can vote all of their shares. But it's subject to vesting, which as an which investors will require to make sure that the founder stays incentivized over the next few years. And then once the stock has value, so certainly after the first priced round, the common stock will have some value. And that's when companies start granting options, because for really two reasons. One, employees don't necessarily want to pay that value for the stock. They want to have the option to get the equity if it may become liquid, or they, or maybe if they're leaving the company, they'll want to buy it. And then also the founders, the investors may not want all of the employees to be voting their shares. So that's why options make a lot of sense for most of the lifespan of a private venture funded company. And then you start to see RSUs when the price is very high of the common stock, and there's more certainty that there'll be a liquidity event soon. So those are really the three kind of phases when we start to see those three different types of equity.
Thanks, Alyssa. I think that provides some really helpful context. Obviously, there's certain outliers for whatever reason companies may at various points, or they have somebody that they've attracted as a senior management candidate who for their own tax planning reasons, right, might request a different type of equity. But that's really, I think, by and large, really what we're seeing in the market and when companies are utilizing each of these types of equity. And throughout this presentation, we're going to get into some of the really high level key terms and specifics for each of kind of the most common, the stock options, restricted stock, and restricted stock units in a little bit more detail. Next slide, please. We can skip and get to the next one as well. So as Alyssa mentioned, I think throughout most of a company's life cycle, they're going to be typically focused on granting stock options, whether it's an incentive stock option or a non-qualified stock option. And the pieces, I think, there's certain terms that an option must include. And there's a few key decision points that are going to be made, again, usually at the board level discussions and, putting into place those type of arrangements. And that's really going to, I think, have a driving in terms of how you're incentivizing your workforce. So one of the key provisions is with respect to the vesting schedule. And that's really, how frequently the individual who received the option will vest. Most companies, and again, this can vary, but most companies are utilizing a four-year vesting schedule for an employee, and the vesting can occur monthly, quarterly, or annually, subject to continued employment through the date of vesting, if there's going to be some sort of time-based vesting component. I would say most frequently these days I'm seeing more quarterly or monthly vesting. In the past, annual vesting I think tended to be more typical, but given that I think and I'll add one point is that companies might have a one-year cliff and then have that vesting schedule thereafter. And so really the goal is they want to incentivize employees to stick around for a period of time, but also kind of face the realities of what other companies are doing as well. A couple of other key provisions, again, that will usually be discussed at the board level with respect to setting option terms are, sometimes this will be done at the onset of the grant, how the options are going to be treated in connection with the change of control. And in particular, if there's any sort of accelerated vesting there, either single trigger tied to the transaction or double trigger tied to the transaction and a termination of employment that's involuntary. I'll say most companies, again, are not including automatic acceleration under those scenarios, except for maybe a few key people. And so I do want to mention that because, again, I think that's something where you really can have a lot of bargaining power and can kind of stand on your own legs if you're in the room making those decisions and coming armed that it's not typical. And so if somebody's asking for it, really being able to have an educated conversation. So, you're kind of doing what's in the best interest for you as a company, because you're now thinking of your strategic exit strategy down the road and what a potential buyer is going to be looking for. The last point I'll mention and kind of key option terms is with respect to the post-termination exercise period. And that's the period of time that you typically have following a termination of employment to exercise your option. And if you fail to do so, it just lapses and you kind of lose that right to that equity. The standard under most equity plans is 90 days following termination of employment. And that's simply intended to comply with some IRS rules related to incentive stock options. And so from a simplicity's sake, most companies just utilize that for all of their stock options. That said, we do see sometimes senior executives when they're coming in, negotiating or asking for a longer post-termination exercise period. 1 to 2 years following termination is, I would say, typical of what I'll see there. And you'll also see a scenario where if your company is contemplating doing some sort of layoffs, and we'll get into this a little bit later on, where you may choose to try to offer a longer post-termination exercise period to certain employees, is really kind of intended to help them out, because they may not have the cash on hand at that point in time to exercise, but you don't want them to lose that ability to potentially share in the upside of the company. Chandra, I was hoping you could talk a little bit about when investors have specific rights to approving terms of certain options.
Yeah, happy to. And hi, everyone. I'm Chandra Shih. I'm a partner here at Lowenstein. I am in our tech group, working with startup companies and venture funds, sort of as general outside counsel and helping with financing transactions. Very much find the topics we're talking about today to be things that I'm talking to clients about on a regular basis, and really enjoy working with both Megan and Taryn, who specialize in this space, because it's an important topic, and it's something that people care a lot about, whether you're an operator or founder at a company, or whether you're a venture investor. So much of the value that people derive from startup companies is through the equity and the potential upside of that equity. And so making sure you're getting it right at the outset is just so hugely important. As Megan mentioned around the post-termination exercise period, the other thing I'd add is that we did see several years ago a push from some companies to just standardize offering a longer post-termination exercise period for all of their option grants and doing it at the outset. There is actually an upper limit on how long you can go, but it's quite long. It's 10 years. And so we saw some companies say, we want everyone to be able to potentially have upside for as long as possible, whether they're with the company or not. And let's extend all of the post-termination exercise periods to 10 years. Viewed generally as a generous thing to do, but from a practical perspective, can really put a crunch on the company and its ability to provide equity to people going forward. You sort of either have to think about being a little stingier with the grants that are being made, or you just have to know that there's so much more sitting out there that you can't sort of take back and use for current service providers, because it's tied up with former service providers who may no longer be at the company, but are going to have as long as 10 years from the date of their grant in order to exercise some of this equity. So there can be real complications around it. And I think the advice there is, anytime you have a company trying to adopt a policy that's going to be in effect for everyone forevermore, talk to people about it first, and the board should really deliberate, because you don't want that to hang over your head for the next decade or two. In connection with financing rounds, it is very much the case that certain stockholder covenants will get put in place that limit the company's ability to issue equity outside of what we would consider typical or normal vesting schedules. It's also going to obligate the company to make sure that any grants that it's making to service providers are subject to what we would call a right of first refusal and post-sale agreement. They have to be subject to a lockup, so when the company goes public, the shares can be locked up for a certain period of time. But vesting is a key one that's in there. And usually what it'll say is that the company's agreeing that for all future employees and service providers, they're going to go ahead and agree that the grants are going to be made on a 4-year vesting schedule with a 1-year cliff. That 1-year cliff means, no amount will vest for the first year. After year 1, 25% will vest, and then the rest would vest monthly for the following 3 years. And there's usually language in there, especially if there's been a preferred director that's joined the board, that says deviating from this will require approval from the preferred director or from the stockholders who sort of hold that covenant. And so it doesn't mean the company can't ever make those grants. It's just that you need that extra level of approval in order to do it, because people just sort of view vesting as such a key a key thing for making sure that the company's cap table and incentive programs make sense.
Can I just add one thing on approvals, for especially for folks who are working in early stage companies? It is required that the board or a committee of the board, like the compensation committee, actually approve these terms of every single option for them to be validly granted. And that's a really common cleanup issue that comes up that we see. It's really difficult to go, you can't go back in time if options were not properly granted. So it's really best practice to make sure that you're working with your lawyer to list out the option grants and that all the details are there, and then actually approved by the board, in accordance with Delaware law.
Yeah, and that's a great point, Alyssa. And we'll get into this in a little bit more detail later, but really having your capitalization structure done properly and all of the grants done properly is something very important, both to investors and buyers throughout the diligent or investment process. And that's something that's going to be looked at with a lot of scrutiny. And to Alyssa's point, there is limited ability sometimes to do, cleanup because you can't go back in time. And so being educated at the onset and making sure that you have proper procedures in place and are following them as you're giving out equity even early on is critical.
Next slide, please. So in addition to the requirements that Megan discussed a few minutes ago, if options are intended to be incentive stock options, which are eligible to receive favorable tax treatment, there are a few additional requirements that you should be mindful of. First, ISOs can only be granted to employees, so it's not something that you can grant to an independent contractor or a non-employee service provider. Also, the annual value of ISOs that may become exercisable or vest in any 1 year based on the fair market value of the date of grant cannot exceed $100,000. And this is important to note because if the fair market value at the date of grant is a little bit higher, it could extend the vesting schedule if you want to take full advantage of the ISO favorable tax treatment. Additionally, there are a few documentary requirements that you should be aware of. The plan has to state the maximum number of shares available for issuance of ISOs, and the plan under which you intend to grant ISOs has to be approved by shareholders within 12 months, the date is adopted by the board. So those are some areas that we see companies may slip up once in a while. Next slide, please. In addition to requirements at grant, there are also requirements during the life of an ISO that you should be mindful of, or else you could disqualify the ISO. If an ISO is disqualified, it is treated as a non-qualified stock option and will lose the favorable tax treatment that an ISO has. So one way that we see ISOs disqualified is if someone tries to exercise an ISO more than 3 months after termination, as Megan discussed earlier. The post-termination exercise period for an ISO has to be 3 months after the date of termination, or within 3 months. So anything longer than that would disqualify it. Another requirement for ISOs is that you must hold them for 1 year after exercise or 2 years after the date of grant. If you dispose of or sell the shares before that holding period is met, it will be a disqualifying disposition, and you will also lose favorable tax treatment. And finally, an ISO cannot be modified to improve the option term for the holder. So, sometimes we see this with someone going to extend the post-termination exercise period longer than 3 months. If you were to do that, that would be a modification that would disqualify the ISO. Another thing to be mindful of here is that you have a 29-day window to make offers with respect to ISOs. So if you intend to modify an ISO that in a way that could disqualify it, if you offer it to an employee, say, for example, in connection with a separation agreement or a termination package, you have to be mindful that the offer to modify the ISO doesn't stay open longer than 29 days. If it does, it will be deemed to have been modified and it will disqualify the ISO. Next slide, please.
Taryn, I'd say just from a practical perspective, one of the places we're seeing this crop up quite a bit, just given the current market, is in some of the option repricing that's happening. Companies may have had valuations that were higher last year or the year before, which resulted in sort of them having an option strike price that's higher than sort of current valuations may be coming in at for them. And so when you're thinking about doing repricings of options, these points that Taryn's talking about and impact on ISOs can be a really important part of that process and just something to make sure legal's looped into right away.
Yeah, and I'll just add kind of another piece in terms of, okay, there's all of these various requirements to have an incentive stock option. So, at a basic level, why do companies grant incentive stock options if they have all of these other alternatives? And, Taryn will get into this in a minute, but really, I think there's, in general, tends to be a push in just, again, the practical market, that the mindset of incentive stock options are better for a number of reasons. And in order to be able to get this potential beneficial tax treatment, you have to comply with a number of, very rigid requirements in order to be able to, get that potential benefit. And so again, that kind of goes back to the onset, the point Alyssa made of making sure that you're involving, counsel or your outside advisors and having in place the proper documents that meet all of these requirements. So then it just becomes easy at the board level to approve them that include all the necessary terms. And really, the big reason that most companies tend to grant ISOs, I'm going to say in addition to, we'll just say that's what everybody knows, is the fact that when the option is exercised, it's generally not a taxable event. And so the individual is coming out of pocket to pay the exercise price, but they're not also then getting hit with having to pay ordinary income taxes. And in particular, if you have people who leave, they're maybe more inclined to exercise if they did have incentive stock options versus non-qualified stock options. But I'll turn it back over to Taryn to talk about this in a little bit more detail.
Thanks, Megan. I would just echo what Megan just said. The biggest difference between ISOs and non-qualified stock options are that incentive stock options don't have a taxable event at exercise, but they are included in income for the alternative minimum tax purposes. Whereas non-qualified stock options, the spread, meaning the difference between the exercise price and the fair market value when you exercise them, is taxable as ordinary income. ISOs also will be taxed on the appreciation from the grant price at capital gains rate when you sell the shares, where non-qualified stock options also have that same capital gains treatment, but it's only after their first tax at the ordinary income rates at exercise. Next slide, please. So the next few slides touch on some advantages and disadvantages of ISOs and non-qualified stock options. I won't read through all of them, but I'm just going to highlight a few. As we mentioned a few times, the advantage of an ISO really is that the tax liability is deferred until the stock is sold, and all gain above exercise price is taxable at capital gains rates if the holding period is met. I would say the one disadvantage of ISOs is that you have heard us mention that there could be some onerous requirements for options to qualify as ISOs, and if those requirements aren't met, such as the holding period, the options are disqualified and they're treated as non-qualified stock options anyway. Next slide, please. With non-qualified stock options, the company gets a tax deduction at exercise since the employee will have to pay ordinary income at exercise. And a disadvantage really is that the employee incurs tax liability at exercise. No one really wants to incur tax liability if they don't have to, so it's really the main reason why people choose ISOs over NSOs. Next slide, please. And just a few disadvantages that are common to all options, that unlike certain other forms of equity, an employee investment is required. So all options have to have an exercise price that the employee is required to pay in order to acquire the shares. Options also dilute earnings per share, which sometimes could be unfavorable. Next slide, please.
So one of the things that Taryn just mentioned in terms of kind of a potential downside is that employees have to pay out of pocket to exercise their options. I'll say though, from the company investor standpoint, that can be beneficial because you're really, for people to exercise and get the benefit of it, you really want them to, have an incentive and to grow the value of the company. And really one way to do that is they're only going to share in that potential upside. And so it kind of gives them kind of a boost to really help drive the economic value of the company. And while I mentioned in terms of the, benefit of ISOs can be, they're not taxed when they're exercised, from a practical standpoint, aside from the outliers where you do have people who leave and choose to exercise their options, even though there's currently not a market for those shares, because they're taking the hope that the company will ultimately have some sort of transaction or exit where they may share in value. But for the vast majority of people, most of the time, option holders, are still holding vested unexercised options and are still continuing to provide services at the time of an exit. And so from the practical perspective, a lot of the tax consequences or potential tax benefits for ISOs may not actually transpire in practice, but it's really, intending to hedge so that people could get that benefit if they leave earlier or choose, even while still employed, to exercise the options at an earlier point in time. So transitioning to another key point that I think is really going to be important for this group to be aware of, especially in VC-backed companies. Ultimately, there's tends to be an exit strategy at some point in the life cycle of the company. And most of the time that's going to be in some sort of, M&A transaction. And so it's important that the company has a lot of latitude under the terms of the equity plan that has granted the options or restricted stock or RSUs to have flexibility in terms of how that equity is treated in connection with a transaction, and that the board has the authority to make that determination, in particular because, while the company may want to do something, a buyer is also going to have say, and they may want some equity rolled over. They may want it converted into equity in the buyer. They may want people cashed out. And so by having a plan in place that allows for a variety of options is really going to be in your best interest, and also give you flexibility and be more attractive to a buyer on a go forward basis. As I mentioned earlier, that some executives might negotiate for certain acceleration in connection with a change of control or double trigger acceleration. But aside from that outlier for, again, typically a few key individuals, most equity plans are going to allow a company to cancel unvested options without payment of consideration. And, that makes sense economically, right? That you're, not giving people for the additional incentive if they haven't stuck around with the company for, a particular period of time.
Yeah.
Another common thing. Oh, go ahead, Meredith.
Yeah, so just to zoom out, so I'm Meredith Beuchaw, I'm a partner in the group, and I mostly do M&A and work closely with Megan and Taryn. It's a board decision what to do with options. We don't see that many people exercising their options unless they've left the company. If someone's exercised an option for purposes of this discussion, they're not an option holder anymore, they're a stockholder, so push them to the side. So what we're really talking about in M&A is your vested option holders and your unvested option holders. And it's pretty clear what you do with vested option holders. That's easy. You're generally going to cash them out. They don't usually have to exercise before the deal. We try to make it really easy. We just give them their proceeds less their exercise price. Megan and Taryn can talk about a couple situations where you might make that more complicated. The unvested ones are really what we end up talking about in the boardroom. And you've got to look at your option plan to make sure that you have full flexibility. If it's well drafted, you will. You don't always, so it's a good thing to know about in advance. We do see buyers coming in and they're very happy to tell you what you should do with your options, and they will typically say, "We'll just assume them and we'll reduce your purchase price," which to a selling company is economically the same thing as if you accelerated all of them, but you're paying for the post-closing retention, which buyers love if you pay for that. You may want to do that. It may make sense if there's an earnout and you want to make sure that you hit that earnout. You want your people to stick around, but otherwise that's never really the best thing if you're selling. You do it plenty of times because you're getting other good terms in a deal. But typically, if you're going to be bearing the cost of it, you might as well make sure your people get paid and accelerate if you can. I'm seeing more and more boards in the current market though say, you know what, we're going to go ahead and cancel all the unvested options. And buyer, yeah, you're going to have some pissed off employees if you don't give them packages that look really nice after the deal. And you reserve the right? If you don't like how the packages look, maybe you accelerate some people because they're not going to have a good role going forward. But with a well-drafted plan, you should be able to pick and choose and not agree up front with a buyer. Sure, we'll pay for your post-closing retention. So, that's important to keep in mind with the double triggers and all that funkiness. I think really what people are negotiating for themselves is acceleration. I mean, a buyer is definitely going to charge you for that. They're not going to say that it'll be on them if you hit the double trigger. So that's a nice place to be as an employee if you can get it. But a board should know that you will end up paying for it in a change of control. There's just no way to avoid that.
Yeah, Meredith, I think that's a really good thing to keep in mind at an early stage. And this is why, single trigger acceleration, meaning all of your shares accelerate when the company is sold, is not a market term, because it leaks value from out of all of the pot of money that is going to the rest of the stockholders. So founders and key executives who negotiate for it often do get double trigger acceleration, but we really rarely see single trigger, except for an independent director or someone who's really a key contributor who is expected to leave the company as soon as it's sold.
Yeah, so thank you both. I think those are really very helpful practical tips to be aware of, and again, really stresses and emphasizes the importance of having flexibility, not only in your plan, but also knowing what we're seeing in the market again, so you kind of come armed with that information when you're in the boardroom making those decisions. Next slide, please. So on the next two slides, I'm going to touch on at a very high level a couple of tax related considerations for stock options. So in general, stock options in non-private companies are set up to have an exercise price that is no less than fair market value on the date of grant. And the reason for this is so that it avoids being considered deferred compensation under the Internal Revenue Code, which, if not structured properly, can result in negative tax consequences to the option holder and also adverse reporting on the company's standpoint. And so it really emphasizes the importance of granting options with the right exercise price to avoid triggering these adverse tax consequences. So one of the ways that most companies use in order to set the exercise price for their options, in part because this isn't entitled to a presumption of reasonableness by the Internal Revenue Code. And so we'll say that's kind of the gold standard in the industry, is that if you have a 409A valuation, which is typically good for a period of 12 months, unless there's some sort of material event during that 12-month period that renders that price no longer accurate, it's presumed that the exercise price that you're using is no less than the fair market value. And so, I'll kick it over to Alyssa and Chandra to really talk about the importance from a practical perspective of having 409A in place for option grants. And this ties back to the point I made earlier about how critical it is to have your cap table done properly and all of your corresponding documents, because it is something that's looked at kind of throughout the diligence process.
Yeah, so this is really important. Anytime an investor does diligence on the company, starting with the Series Seed financing, their lawyers will look to see if the company has been relying on an independent valuation report to set the strike price of their options. And it is immediately a red flag if the company hasn't been doing that, because investors want to make sure that the company isn't creating tax risk, not only for the company, but for these really essential early employees who are the ones who ultimately would have to pay penalties if the company wasn't granting options in compliance with the deferred compensation rules.
I would just add to that, it can definitely be a huge nightmare, especially the longer it's gone on. And as Alyssa mentioned, it's really your employees and the people who received these who didn't have any say in setting the price that really bear the brunt of the negative tax impact. And so what that means is companies oftentimes have to scramble to figure out a quote unquote fix for these people that makes them whole. Maybe it's getting them more cash, maybe it's getting them more equity at whatever a new price is, but it can really move dollars and cents. And I'm sure Meredith probably would say the same on exit. I mean, it can be a huge issue. So it can shift prices.
I'm going to pile on here. Please get this right, because your buyers are going to look at every issuance. They're going to say to you, why on earth did you think that was the right value? You can't show us any, like they will really dig in. If this is not correct, it becomes a really big problem. So be in the habit of getting these done. They're not that expensive. They don't take that long. And then very important is this last point, that if there's a term sheet, your 409A is no longer valid, which means you can't issue options anymore. Don't do it. I've also seen buyers, like, people know a term sheet is coming, so they do a really quick options issuance. I've seen buyers say it's too close in time. We had told you we were going to put in a term sheet. You can't do that. So when you're starting a sale process, before you know term sheets are going to come in, that's a good time. You can promise options. Once it comes in, you just can't issue them, and then you just do sale bonuses instead there.
Yeah, and I think those are all really helpful practical points, because this is really where we see the pain points in, various seed investor rounds or at exit. And as Meredith mentioned, it is something that a buyer is going to be very focused on. And if there is an issue, that could also have an impact on the deal price. There could be asking for some indemnity. So there really could be other kind of costs from an investor side associated with having some sort of issue. So I know we have about 20 minutes left, so we're going to kind of try to tick through the next couple of topics pretty quickly at a high level, just to kind of make sure that we kind of get these items on your radar. Next slide, please. Next slide, please.
So as the rest of the group just mentioned, I would say the number one pitfall with respect to options is failure to grant options at or above fair market value. Like everyone just said, this is something that every buyer, every investor is going to look at and make sure you did right. So it's the number one rule when it comes to granting stock options. Similarly, granting options in advance of events that could have an impact on the share price is, we just discussed that in detail. So, that's one of the ways we see options, run afoul of what investors and buyers are looking for. Another thing that we see is failure to properly and timely document option grants, but treat them as approved. So a lot of times in the course of a sale or financing round, when it's time to due diligence on the options and people are looking for the board consents that approve the options, as Alyssa talked about earlier, we find that they weren't actually approved. And without board consent, you can't treat the options as validly granted, which means your choices are, issue options now, which would have a higher fair market value and may not make sense if you're in the context of an M&A transaction, or sometimes you have to issue deal bonuses that would give the individuals the value that they would have had the options been granted validly. Another pain point we see is a delay in obtaining board approval of option grants promised to employees. Sometimes you'll see an employee who is being onboarded will have a certain grant promised in their employment documents. And if it may take 1 to 3 months to actually get those documents in front of the board and have them granted, and at that time, the fair market value of the stock could have gone up, which means the exercise price of that grant will have to go up. Another, we talked about this earlier, but another big change is big pain point is failure of a plan document to have flexibility to cancel the options without consent or to cancel unvested options. And really just, you want to make sure that plan has flexibility for the board to be able to decide what to do with the options when there's a change in control.
And I'll just briefly add that a lot of these items don't always come out until you're undergoing a sale or exit process. And so really what it could be best practices that we typically advise our clients are, to periodically review or make sure that you understand the process for properly granting and documenting option or other equity issuances, and making sure to, kind of, we'll say, self-diligence that process or your corporate records, again, periodically, so that if there are any things that require cleanup, it's done on a more timely basis.
And I will say, as part of the legal due diligence process for like venture investors in the room, your legal counsel is looking at this stuff in connection with the legal due diligence it does. Sometimes in earlier stage deals, or frankly, even some sort of mid-early deals, there's been a bit of a crunch to cut out diligence. But stuff like this is important for your counsel to be able to look at, because it's really hard to change it once you're at that sale process or you're at some future time. And so catching it early is always best.
Next slide, please. So at a super high level, what are some best practices with respect to options that you can do? Promptly and accurately document all grants. Make sure you get your board consent. Make sure you get your independent valuations at least every 12 months, and avoid granting your options in advance of any term sheet or any other material event. This is something that's going to be looked at very closely by investors. And if there are any material events, just reconsider the exercise price of those options. Next slide, please.
So I'm going to just briefly, throughout the next couple of slides, touch on at a very high level some of the market trends we're seeing with respect to some of the topics that we briefly touched on already, and about a few other things that we're seeing. So as I already mentioned a little bit earlier in the presentation, that the typical post-termination exercise period for most options is 90 days. However, in particular, we've seen this become more frequent, either on a case-by-case basis or when folks are being terminated in connection with reduction in force, especially given the current economic climate. We've, over the past 6 months, seen many more clients, unfortunately, undergoing RIFs, and kind of as part of the package that they give people, they are giving them a longer time to exercise their options. Next slide, please. Next slide, please. And again, I'll just briefly mention, as Taryn alluded to earlier, there's a particular timing elements involved with extending the post-termination exercise period for incentive stock options, and that it really needs to be done properly and carefully to avoid there being a modification that disqualifies the option from receiving the ISO treatment. Next slide, please. So one of the things that we're seeing more frequently lately is options that are approaching their 10-year expiration. And I think this is a virtue of, again, maybe potentially the current economic climate. Companies are taking longer to exit than they historically did. And for those early employees who were granted options early on, the company is kind of left at what to do if those people are still around and their option has vested and it's going to be expiring. So for tax reasons, you cannot extend past the 10-year anniversary of an in-the-money option. And so that leaves you kind of, should we do something, and what are our alternatives? From a legal standpoint, a company doesn't have to do anything. But there are some things that we see companies looking to explore if they really want to try to make these people whole, especially if they've been around, since early on. They're continuing to be a rockstar employee, and you want to continue to incentivize and retain value there. They really want to try to help that option holder if possible. And so some of the things that we see companies trying to utilize is doing things to help the optionees exercise their options, such as giving them the ability to net exercise, giving them a loan to exercise, potentially when their options expire, grant new options at the current fair market value. So while they've lost out on some of that incremental value, they're still getting something, potentially with vesting credit, or give them other sort of compensation, such as phantom equity that's intended to mirror the economics of what they gave up. One other item I think we briefly wanted to touch on in terms of really what is compensation that we typically see for members of the board. I think in terms of equity compensation that they receive, and I do typically see that as part of the comp package, the vesting schedule that's utilized for directors is going to be, a lot quicker because it's going to be typically tied to the term for that director. So for most directors, it's, 1 or 2 year vesting schedule, and they would be granted non-qualified and not incentive stock options. And as the point mentioned earlier, is sometimes, depending on their role, they may have some sort of acceleration in connection with an exit of the company. Chandra, do you have a little bit more that you want to add from kind of what you see? I know you're involved in a lot of those discussions at the board level.
I think the answer to what board compensation looks like is it depends a lot on the stage of the company and what your role is on the board. Certainly for later stage companies or public companies, of course, there's a lot that goes into director compensation. There can be a cash component. There certainly is a significant equity component, and as Megan mentioned, vesting is really quite different looking. For early stage companies, we really don't expect you to have, early stage private companies don't typically have outside directors at the outset. Certainly their outside directors that join are ones who are typically associated with venture funds or whomever their sort of investors are for particular financing rounds. Those folks aren't typically compensated via equity because they're just sort of on the board and monitoring their investment from their perspective, right? And then the other board members are typically management who have incentive via equity and compensation through their sort of management positions. Once a company gets mature enough and it starts having sort of independent directors join the board, that's where we start to see more of the board compensation topics happening, even at sort of mid or growth stage companies. And it really, really depends on who the board member is, what level of expertise or independence they have, and what the company's sort of cap table and cash position looks like. And so there's never sort of a one size fits all, though I do think that there are better markers once a company's much more mature, particularly if it's public, you could go benchmark pretty easily.
Great, thanks, Chandra. So I'm going to turn it over to Taryn to touch on something else that we're seeing pretty commonly in the market with respect to, underwater stock options. Taryn?
Thanks. Next slide, please. So as Megan mentioned, we're frequently seeing stock options underwater in light of the current economic climate. And what we mean by underwater is that the exercise price of the stock options is less than the fair market value of the shares. So there are a few things you can do to address this. First, you could take the wait and see approach and not do anything and see if the stock price increases. It is possible for underwater stock options to become in the money. You can reprice the option, which means that the current option agreements are amended to increase the exercise price to the current fair market value. Or you could do an exchange for another security. So you can either cancel the existing option and issue new options with the current fair market value, or cancel the option and issue restricted stock or RSUs or some other type of equity award that reflects the current fair market value. You could also grant refresh stock options. So new options to supplement the underwater options, not cancel the ones that exist, but just try to make them whole through a separate grant. Next slide, please.
So one thing we want to just touch on briefly is that there are stock options can be granted with an early exercise feature. And really what this allows you to do is to pay the exercise price and exercise the options before they vest, in a sense, converting them into restricted stock. And the reason for doing this is to start the clock for long-term capital gains treatment and to reduce the amount of tax that would potentially be owed upon the sale. But the challenge with this can be if the options are granted to people not right when the company has no value, this is going to be a taxable event. And so people are going to then have to come out of pocket not only to pay the exercise price, but also pay the taxes associated with that.
And I think on early exercise, just from a practical perspective, you should all be aware that if you sit on a board or you operate a company that's going to implement early exercise, if you're doing it across the board, it's a huge administrative burden for the company and your like management. And it's not something that we see implemented lightly for that reason. Certainly doing it on a case-by-case basis can make sense. But across the board implementation is tough, and it's tough, especially as you grow.
I've seen this work well with companies, with founders who've been through it a couple times, right? They know what they're doing. They have a small, very talented team that knows the process, and you do it so early that there are 5 people you're talking about. Do you see it work in that scenario?
I agree with that.
Yeah, I think it's much more common in that scenario. And I will add, we're not going to touch on it through the scope of this presentation, but we do see companies to really help try to incentivize people if they have early exercise options, to try to help them get involved with doing a loan program. But there are complicated tax considerations with doing that. And so I'd urge you that if that's something that you're trying to explore, consider to consult with your legal and tax advisors to make sure it's done efficiently and properly, because there can be unintended consequences and it can be difficult to unwind that, especially in a scenario where the stock price potentially dips and the options that you previously exercised and took a loan for are now underwater. Next slide, please. Next slide, please.
So far, we've been talking about options. Another type of equity that we commonly see in this equity plan is restricted stock, and that's a grant of shares subject to forfeiture if vesting conditions are not satisfied. The real benefit with restricted stock is that generally it has ordinary income on the fair market value when the shares vest, but you also have the option of filing an 83B election to accelerate the tax to the time of grant. Next slide, please. By filing an 83B election and accelerating the tax, you can choose to be taxed at a time when the fair market value of the property is nominal. So for example, service providers and early stage companies where the stock has little to no value can end up paying little to no tax on those shares. And it also starts the clock on the taxpayer's capital gains holding period. Next slide, please. 2 things to be aware of with respect to 83B elections are you have only 30 days from the date of grant to file the 83B election, and there's no extensions to that. And if you do file an 83B election and later forfeit the shares, there's no way to recover the taxes that you pay when you file the 83B election. Next slide, please. One of the main benefits to restricted stock as opposed to options is that it promotes immediate stock ownership. So, as Alyssa mentioned earlier, certain founders may want immediate voting rights, and it allows them to do that. The one downside is that if the stock is not publicly traded and an 83B election is not filed, you'll have ordinary income upon vesting, which can be significant. And if the stock is not liquid, then you might have to do some creative planning to address the income tax and withholding obligation. Next slide, please. As I said earlier, the best use of restricted stock is really where a company has a very low value. In that situation, you file an 83B election and you incur very minimal tax. Your risk of loss, if the shares are forfeited, is minimized, and you have an opportunity to have all of the appreciation taxed at long-term capital gains rate. But restricted stock is not typically used by public companies or non-public companies with significant value. Chandra, did you want to touch on the issue we were seeing where founders are diluted by certain safe rounds?
Yeah, and I'll just speak quickly because I know we've only got a minute or 2 left, but we are seeing, with the emergence of safes being used, sometimes companies are using them longer and for higher sort of value raises than they had in the past. It's causing some significant dilution to founders when those safes actually convert. And so, as Taryn mentioned, restricted stock isn't typically great for private companies with significant value. Once you've got sort of a round that's closed and the company has value, but the founder needs to be re-incentivized, there can be a real cost to getting them more equity. And the founders don't typically want options because they want to be able to vote their shares, right? So there are ways that we see that get structured. There are things you have to think through, but it can be expensive to founders. And so it's something where you just want to be thoughtful about it and consult early to figure out what the best solution might be.
So in the last minute, because I do want to be respectful of everyone's time, I'm just gonna, we'll say it at 10,000 foot level, briefly touch on RSUs and then put out there a couple of other types of equity that's utilized. So as Alyssa mentioned earlier, typically in the private company space, restricted stock units are not often utilized. So restricted stock units are full value awards. The individual does not have to pay into. One of the downfalls with RSUs is that when they're vested, that would typically trigger a taxable event. And again, that might be a period of time when there is no liquidity for the shares that you're being issued. And so what most companies tend to try to utilize to delay that taxable event is subject the RSUs to both a time-based and liquidity-based vesting condition. And so even if somebody has met the time-based criteria, there still needs to be an IPO or an exit in order to have the RSUs fully vest to delay that taxable event. And again, just briefly for tax reasons, there typically is a deadline for the liquidity event to occur. And in market, we see that most often is 7 years from the date of grant. Some other alternatives that are out there, and again, there's more information about this in the materials, so feel free to kind of read it at your leisure. And again, with any of these topics, feel free to reach out to myself, Taryn, or any of my other panelists if you have any follow-up questions on anything we covered or really anything at all in this space. But some other alternatives to equity awards are phantom equity, which can really be structured to mimic, we'll say, the economics of traditional equity award, but it's really just a contractual right to a cash bonus at a future point in time. The negative with that is that it would be treated at and taxed at ordinary income rates, but you have kind of a little bit of flexibility in terms of structuring the terms, although you should always work with legal counsel to make sure it's documented and drafted properly from a tax code perspective.
The one plug I'll give for phantom equity is the fact that we are seeing distributed workforces a lot more today, both because of COVID, but just because of the way the world works. And the companies we do see utilize phantom equity are typically ones who are looking to incentivize service providers that might not be in a place where stock options are practical or tax efficient or anything else. And so that's typically the context we see it, but it is complicated. It takes work, takes time to administer, and it is something different than equity that you have to be thinking about every time you're doing a transaction.
Yeah, and a great point to add on that is it's not something, because it's not traditional equity, that's going to show up on your cap table, but it is going to be an obligation that you will have to pay out at the time of an exit. So making sure if you are utilizing that to really figure out where it's going to fit in terms of your cash flow if there's an exit. And then the last thing I'll just mention, just to be aware of, is if you are an LLC, which again, most of our clients in this space are not, is you can issue profits and capital interest. And there are specific requirements of what those need to include and how they need to be structured in order for them to be able to be treated that way for tax purposes. Again, I appreciate everybody taking the time to join us today. I hope this was a good and useful discussion, providing both some information just to be armed and ready and educated as you're kind of in the rooms having these discussions, but also to kind of understand, again, kind of what our collective group is seeing in the market, and so that you can kind of make informed decisions as these issues arrive. So thank you everybody for the time today. I hope you found it useful. And again, we will follow up with a copy of the slide deck to keep as reference material for all the attendees today.
Megan, Taryn, thank you. Awesome.
Thanks, everyone.
Thanks, everybody.